Gold prices have crashed. Gold prices have crashed. Since 2011, gold has plummeted more than 25%, and the worst may not yet be over. The Profit Strategy newsletter at ETFguide.com warned its subscribers the gold bubble would pop, and it has. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. What happens next in the gold market will shock the entire globe. Join today at ETFguide.com and get a $50 bonus by using promo code SAVE50.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
All right, welcome to the program. Coming up on today's show, Google hits $1,000 a share. Holy Toledo. I remember when Google was $85 a share and people were saying it was overpriced. So what does it mean for the technology sector? We'll take a look at that particular industry sector. If you're just joining us, we're here. If you want to talk about a particular stock, mutual fund, ETF, 877-711-5611. We'll also talk about the U.S. stock market hitting all-time highs this past week. Of course, celebrating temporarily so that U.S. agreement between lawmakers to extend, or rather suspend, the debt ceiling, and of course reopening the government and agreeing to work on a budget or have a budget by December 13th. So we'll talk about the stock market's reaction and get you caught up on all the major market trends. Again, if you'd like to join us, we're here. 877-711-5611. If you want to talk about a particular stock, mutual fund, ETF, I'm game. So really, actually, I want to throw this out to all of our listeners. I often test the intellect of this audience. Now, I have no question about the intellect of the audience, of course, except for some of you. But for the most part, I would say the intellect of this audience is pretty high. So now I want to test the amount of how much you've been paying attention to what's been happening in financial markets. So this is today's trivia question. And the person or listener with the correct answer will get a signed copy of my book, Gents with No Sense. So listen very closely. This is not, by the way, and I emphasize this is not a knowledge or intellect question. This question, it focuses on how much you've been paying attention to what's been going on in the financial markets. So he or she who's been paying the most attention will get the answer correct to this trivia question. So here it goes. Which investment category was the best performer leading up to the U.S. government's latest debt agreement? Was it A, stocks? Was it B, bonds? Was it C, volatility? Or was it D, gold? So which one of those four particular categories was the best performer leading up to the U.S. government's latest debt agreement? If you know the answer, call the program, 877-711-5611. And if you're give us the right answer, you'll get a signed copy of my book, Gents with No Sense, a closer look at Wall Street, its customers, financial regulators, and the media. So yes, disaster was averted. That's pretty much how Wall Street and the media characterized the U.S. government's latest deal to suspend the debt ceiling through February 7th of 2014. Now, in truth, the latest piecemeal agreement is just another embarrassing example of a pathetic attempt to fix deep-rooted structural problems with quick, off-the-cuff, short-term maneuvers. Now, we can state with complete confidence that the U.S. government's headline public debt figure of $17 trillion grossly understates the actual amount owed. Let's take that one step further. Let's assassinate conventional wisdom, which states that Japan has the highest debt load of any developed nation in the world. Is it true? In the Wall Street Journal last year, in a piece written by Chris Cox and Bill Archer, they estimated that the federal government's actual liabilities are closer to $86 trillion, or 550% of gross domestic product. Now, that analysis included not just the headline debt figure of $16.9 trillion at that time. We've already gone over that level, by the way, in just a couple of days. But it also includes other significant costs that the U.S. government is on the hook for, including social insecurity, Medicare, federal employees' future retirement benefits, and so forth. So when we add all of these things to the mix, people, we look at 550% of gross domestic product for the U.S. government compared to Japan's debt to GDP ratio, which is expected to hit 230% in 2014. So we just assassinated in less than 2 minutes the false theory, the false belief that Japan has the highest debt load of any developed nation in the world. It's not true. The United States has the highest debt load of any developed nation in the world. 877-711-5611 is the number. Ultimately, financial stress of an aging population, exploding public debt, future economic shocks will result in a financial reckoning day. But until then, the reckoning day has been delayed, and the stock market, which is a leading indicator, hit an all-time high this past week. S&P 500 topping at 1745, mid-cap and small-cap stocks following suit. For now, the risk on trade is alive and well, but the stock market may seem healthy, but we've got some caveats, folks. Rising and overly bullish sentiment is a caveat. Now, I know the technicals still say the market's in an uptrend, and that is true, and we don't doubt the technicals. The technicals are there, although the fundamentals may not be. The latest survey from the American Association of Individual Investors, they do a sentiment survey, shows that bullishness on stocks among their members is now above the long-term average of 39% and is now at 46.3%. Meanwhile, bearishness has dropped below its long-term average of 30.5%. And bearishness now sits at almost 25%. So do you see the discrepancies? We've got overly bullish sentiment. We haven't had a correction of 10% in quite some time. But again, the market remains in an uptrend. Short this market to your own peril. We need to see a further breakdown before that will be a safe trade. 877-711-5611 is the number. If you want to join us to talk about a particular stock, mutual fund, ETF, I'll get to your calls. Stand by. Taking a look at some of the major market indexes. Well, let's begin with the sectors right within the S&P 500. If you want to know how strong this particular market has been, all you got to do is take a look at the 9 ETFs tracking the 9 industry sectors within the S&P 500. Every single one of them in double digits. The lowest performing ETF or sector within the S&P 500 is utility stocks, which have gained no less than 13.22%. Pretty darn good gain for a laggard. XLU tracks utility stocks. Again, that's the worst performing sector within the S&P 500. It's up 13% since the beginning of the year. Pretty darn good return for a laggard. And I put the word laggard in parentheses. So, do you see what's happening here? All 9 sectors across the board are in double digits. There's no discrepancies here. The market is up strong. Healthcare stocks, which we've talked about numerous times, continue to lead the market higher. That is the best performing sector. XLV ahead by 33.5%, easily outperforming the broader S&P 500. If you'd like to join us, we're here, 877-711-5611. We'll get to the trivia question in the next segment. I'll be right back.
The Index Investing Show with Lon DeLegio.
Okay, so I know naysayers are saying that this particular rally that we're having in global stocks is a manufactured rally. It's fictitious. It's something that's been pumped up by global central banks. And really, I can't argue with that particular thesis. If we take a look at developed countries across the world, that seems to harmonize with that particular argument, that those countries whose central banks have been the most aggressive are the same countries whose stock markets globally are outperforming. And we did this, we do it every month in my monthly newsletter at etfguide.com. We just published our November newsletter, and we have a global equity map. And what do you know? The very countries whose stock markets are outperforming the rest of the world, like Japan and the U.S., are the same ones whose central banks have been the most aggressive. You take a look at the year-to-date performance of Japanese stocks, ticker symbol EWJ. EWJ is the iShares ETF that tracks Japanese stocks, ahead by almost 24.5%. U.S. stock market, ticker symbol VTI, ahead by 24.5%, almost that same amount. And then in Europe, ticker symbol VGK, which is the Vanguard European ETF, ahead by just over 19%. So those three regions sharing a common thread, a common bond with central banks that have been the most invasive. And of course, this has helped to boost the stock market's performance in those regions. Let's go to Washington. We've got Mark. And before I bring Mark on the air, our trivia question is this. Which investment category was the best performer leading up to the U.S. government's latest debt agreement? Was it A, stocks, B, bonds, C, volatility, or D, gold? Let's go to Mark in Washington. Welcome to the Index Investing Show. Nice to have you with us, Mark.
I think that the choice is stocks.
That is not correct, but a great guess. Thank you for that answer. So that gives you three possible choices. Which investment category was the best performer leading up to the U.S. government's latest debt agreement? We know it wasn't stocks, so was it B, bonds? Was it C, volatility, or D, gold? Call the program, 877-711-5611 if you know the answer. And the correct caller will get a signed copy of my book, Gents with No Sense. Let's go to beautiful San Francisco. We've got Bob with us. And San Francisco Transit, by the way, is on strike. Bob, are you able to get around?
Well, I live in the city. I'm retired. I can walk anywhere I want. The air is fresh. It's cool. You don't sweat. And I'm feeling pretty good these days. With my miserable
beautiful.
Social Security check, but I've got my investments.
That's a beautiful thing. That's a beautiful thing. Thank you for that update, and we're glad you can walk. And
you bet.
So talk to me, my friend.
Okay, my friend, I just started listening to you, and I like your show. I like the variety. You get down to special issues. You get the ETFs, broad issues. And I have an ETF, Wisdom Tree, and I wonder, how do you evaluate a stock like that? They're a pure play in generating ETFs rather than being an investment banker, which has an ETFs department, you know. And do you evaluate them on the basis of the total value of their capitalization based on the number of ETFs they're constantly generating, or do you evaluate them on earnings or some combination thereof? Because Wisdom Tree, WETF, it hit a new high last week.
Right,
Friday,
and
I believe.
Yeah, that's the ticker symbol. It's listed on the NASDAQ Stock Exchange, WETF. That's Wisdom Tree Investments. Now, Bob is talking about the stock of the company itself, not the
rather
ETFs.
than the ETF.
Exactly. So really what we have to do, and this is the same kind of formula that we practice when comparing ETFs in like categories. Wisdom Tree is a asset manager. And the way that we compare asset managers is we have to look at them relative to their peers. So how is it valued as a company relative to its peers? So that's the first step in evaluating a company like Wisdom Tree. And
it has no peers. It has no peers because it's a pure play.
Well, you do have Barclays, which is a
they're
publicly
a bank.
They are. This is true. This is true. It's a diversified company that has their hand in the ETF business, not a pure play like Wisdom Tree. And really, you're exactly right. There are a dearth of companies. I can't really think of anyone aside from Wisdom Tree. Most of them are privately held.
Exactly, and I think they may be a possible takeover too. So that's an extra kicker in their value. I think they're undervalued, by the way, but that's just why I'm calling you. Maybe you have a better idea.
Well, on a valuation basis, I mean, if we're using Warren Buffett or the value investor type of hat or methodology, it's not a value play. I can tell you that. I mean, the PE ratio on this stock, that's Wisdom Tree, is at 62. That's pretty high, I would say, in any sector, but especially for asset managers. It does have a market cap of almost $2 billion. Well, actually, closer to $1.5 billion. And over the past year, Wisdom Tree's stock price has jumped 86%. Now, let me ask you I should have probably asked you this from the beginning. Do you currently own this stock?
I do. I'm holding on. It has slow periods where it just kind of eases off and it bobs around a little bit, but it's holding up, consolidating, you might say, and then it makes another move with the market.
Yeah, well, that's another thing too. Most of their funds, if you take a look at this very closely, are very closely linked to equity markets, and so you will see the performance of asset managers' stock prices move up and down relative to what the market does, because of course their revenues are based upon assets under management, and right now assets under management are bulging just because stocks are peaking. So you've got that potential risk, but I do share your view that I think they are a potential takeover candidate, and I think you've done pretty good here. You have certainly a lot more guts than I have in investing in an individual stock of this nature. But I would say, hang on to it and put in some stop losses. Definitely, if you've got paper profits, you don't want to lose those. If for some reason something goes wrong in the market, do you use stop losses or not?
I don't really like to signal what my opinion is the future, because I think you put too many stop losses, you're letting the really smart traders pick up on what's going on in the market, and they can react much faster than I can.
Right. Well,
I'd rather take a certain loss and then sell out.
Yeah.
In other words, I've gone over the top and I've hit a certain level, I'm out. I just call it a mental stop.
Yeah. Well, it's good. I like to have actual stops just to protect my downside, just in case. But mental stops are a good second choice. But hopefully your stock in Wisdom Tree will continue to grow, and you've done a good job here. And of course, I remind all of our readers. Thank you for the call, by the way, Bob.
Thank you. I appreciate it.
All of our listeners, rather, not readers, that investing in individual stocks is a very risky game, and it's okay to do that. I'm not going to criticize you for doing that or tell you not to do that, because I'm not dogmatic. But what I will say is that before you begin this journey into individual stocks, you should first have your portfolio built on a diversified foundation of low-cost index funds that touch all major asset classes. So that's your foundation. That's your priority. After you've taken care of that priority and you have some extra money and you want to invest in individual stocks like Wisdom Tree or whatever else, Twitter's upcoming IPO? Be my guest. This is the Index Investing Show. I'm Ron DeLegge. I'll be right back.
The Index Investing Show with Ron DeLegge.
Meet Joe Investor. He's nice and he means well, but Joe Investor always misses the really big investment opportunities. For example, Joe Investor missed last year's 16% gain in small company stocks. And the year before that, he missed the 33% gain in long-term U.S. Treasury ETFs. And what about this year? Well, like all the times before, Joe Investor once again is all about lost opportunities and missed chances. Are you always missing out, just like Joe Investor? The Profit Strategy newsletter at etfguide.com will help you to stay on top of major investment trends so you never miss another big opportunity. Join today and get a $50 bonus by using promo code JOE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started. And one more thing, promise yourself to never ever miss another big investment opportunity.
So we still have not had the right answer for our trivia question, and it's a multiple choice question. And we already had one caller who had the wrong answer, and so the multiple choices has been reduced to 3. The question is, which investment category was the best performer leading up to the U.S. government's latest debt agreement? We know that it wasn't stocks, so the final choices, was it B, bonds, C, volatility, or D, gold? If you know the answer to that question, call the program 877-711-5611, and the right answer will get a signed copy of my book, Gents with No Sense. Very easy question. Not as hard as you think. This is not an intellect question. This is not a knowledge question. This is a dexterity question. This is a question of how much have we been paying attention to what's going on in financial markets. Let's go to Santa Rosa, California. We've got John with us.
Oh, hi. Good morning.
Good morning. Welcome to the program.
I think I may have the answer to that. I think it's the VIXs.
The answer is correct. Good job. An off the cuff guess.
I didn't realize that nobody had gotten the answer. I just assumed that everybody had been reading the same papers I've been reading.
Beautiful. Well, stand by. We're going to get your address before you jump off the call. But now you wanted to talk about something else. Talk to me.
Oh, yeah. There's a stock called Mankind that I currently own, and I was considering buying more.
Okay. And the ticker symbol on this stock for our audience is MNKD. That's Mankind Corporation, and they spell that with 2 N's. They flunked English, but on a positive note, they're doing great in chemistry because the stock over the past year has climbed 166%. That's a beautiful move. Mankind Corporation, by the way, is a biopharmaceutical company, and we take a look at the performance of the stock not just by itself, but also relative to the rest of the biotech sector. And we take a look at, we use as a measure the iShares NASDAQ Biotech ETF, that's ticker symbol IBB. And if we look at Mankind's relative performance to its peer sector, biotech, and the ETF tracking it, well, it's handedly outperformed the biotech sector, so that's good. That's a good sign. This is still a pretty small company. It's got a $1.5 billion market cap, so it's what we call a small cap or small company stock. And it looks like it's come off of some of its highs. It hit a peak high of $8.29 on August 2nd, and it has since fallen to around $5.30. So I would say if you're interested in buying more shares, you're certainly doing it at the right time. You're doing it on a pullback. And what is your cost basis, John, on this particular stock?
First time was under $2. The second time was under $4.
Pretty good buy points. in this particular stock. And like I said to an earlier listener, just make sure that you don't lose those profits. I know they're on paper, but it's always a good idea to put in some stop losses just to protect your downside in case something crazy happens. And doesn't that work like that in life? Something always crazy happens and blindsides us, and then all of a sudden our paper profits evaporate. And I just hate to see that. So I would say look at your stop losses, put some of those in, protect yourself on the downside, and do check back with us and let us know how it works out.
Well, thank you.
Stand by. We're going to get your address.
Thank you very much.
Let's go to Len in Santa Rosa. Len, welcome to the Index Investing Show. Nice to have you with us.
Oh, well, thank you, Ron. It's good to hear you. I got the answer wrong to your trivia question. I thought it was bonds because I was under the impression that if bonds ever went cattywampus, we'd all be in deep kimchi, to mix metaphors. But the real question I had was, you mentioned the $585 trillion debt that really exists. What would we, or the country, or the world look like if we had paid that debt up? If we were all, tomorrow it was all paid up, would life be different or more spectacular? Can you give me some characteristics? Thanks.
I really don't know if life would be that different. Really, I don't know. I mean, have we ever had a situation where we've been debtless? I mean, I don't know. I think the point here is that debt, at what point does it become unmanageable? At what point does it become unsustainable? That's the real thing that gets me scared, because we can't continue to borrow and borrow and borrow. And then the other thing, too, to think about is we've had a relatively tame interest rate environment. I mean, we've got the Federal Reserve with the pushing the pedal to the metal in manipulating interest rates down. What if interest rates all of a sudden, what if the credit market says, you know what, we're sick of this political nonsense out of Washington, D.C. We're going to start demanding higher interest rates. We haven't seen the credit market yet do that. So at that point, when the credit market starts demanding higher interest rates for lending money to the U.S. government, I think you've got a real serious problem. And at that point, you're backed into a corner. But these are things that have not yet happened. I'm just giving you these scenarios so that you can have some perspective on the bigger picture. So right now, if we take a look at the bond market, if we take a look at the stock market, not much fear. Not much fear at all about these things, but the market is, well, Mr. Market is a madman, and he has the tendency to quickly change his moods and opinions and views. So we've got to be ready for anything. And all I'm saying is at some point this is going to become unmanageable. The market's going to say, hey, enough is enough. And by the way, bonds, you mentioned bonds. It's funny you mentioned them, because over the past month, leading up to the debt ceiling agreement, we take a look at the long-term U.S. government bonds, which have been the worst performers across the bond universe. Ticker symbol TLT is the iShares U.S. 20-plus year Treasury bond ETF, up 1.63%. So I'd say a pretty good return leading up to the U.S. debt agreement. And that return tells me very clearly that the bond market wasn't concerned at all, Len, with a possible default.
Very interesting. Well, thank you, Ron. I appreciate the good word.
Appreciate the call, Len, and do check back with us, 877-711-5611. And yes, the best performing category, investment category, if we can even call it that, was the VIX, or volatility, which beat all major categories over the past month. Leading up to the U.S. debt agreement, the VIX climbed 29%, whereas gold sank 2.5%, or just a little over 2%. The total U.S. stock market was pretty much flat, and bonds were the second best performing asset class, gaining just a little over 1.5%. So what is this saying? Well, it pretty much tells me, my interpretation is that if you want to hedge against political instability, if you want to hedge against political gridlock and turmoil and the bickering, well, no better way to do that than going long volatility or the VIX. And by the way, I don't recommend I do not recommend VIX ETFs because, well, as I've told you before, not a very good way, in my view, to play the performance of the VIX, because the latter, VIX ETFs, don't always fully reflect short-term stock market volatility. For example, the ProShares short-term VIX ETF, VIXY, over the same 1-month period gained just 8.3%, while the VIX index itself gained 29%. So what's the discrepancy? Well, VIXY gives you exposure to the 2-month front VIX future contracts, and as recent price action illustrates, there can be very, very significant variances or differences in the performance of VIX futures contracts and the VIX index itself. So if you're going to play the VIX, use call and put options. That's just my friendly advice. This is the Index Investing Show. I'm Ron DeLegge. 877-711-5611. I'll be right back.
The Index Investing Show with Ron DeLegge.
All right, 877-711-5611 is the number. You're listening to the Index Investing Show. You can follow us on Twitter. @Index Show is my Twitter handle. Again, that's @Index Show. You can tweet the program live or throughout the week. We also publish a podcast. If you ever miss our regular weekly broadcast for whatever reason, you can pick up our podcast for free. It's available at iTunes and also YouTube. So just search under the Index Investing Show and you will find us. Now, so far in terms of earnings here in the U.S., of the 97 companies within the S&P 500 that have reported quarterly earnings for the third quarter, 69% have reported above estimates. Now, this percentage is still below the average 73% recorded over the past 4 years. But again, we got the market hitting all-time highs. The S&P 500 topping out at 1745. Now, the Dow did not hit an all-time high. That's called a positive divergence. And the Dow did not hit an all-time high. And I wrote an interesting article at etfguide.com about this very thing. Actually, the title of that article was "The Dow's Flaws Uncovered." And I encourage you to read that at etfguide.com. That's the title, "The Dow's Flaws Uncovered." It is a flawed benchmark for many, many reasons, including its latest index changes that have impacted in a negative way the performance of the Dow. But nevertheless, earnings relatively decent for the S&P 500. The blended earnings growth rate for S&P 500 overall for third quarter is 1.3%, which is slightly above the previous week's growth rate. And upside earnings surprises reported by companies in industrial sector, that's General Electric, technology, Intel, financials, Morgan Stanley and Goldman Sachs, were partially offset by downward revisions in estimates for companies in the energy sector. So there you've got it. The growth rate, by the way, for the S&P 500 index, again, the projected growth rate for quarter three earnings was 3.1%. So there you have it. In terms of individual stocks, we alluded to Google this past week. Google hitting $1,000 a share, and Google is part of the technology ETF and technology sector within the S&P 500. Ticker symbol XLK is the technology spider that owns 73 tech companies, of which Google is a part of. Google is actually the second largest holding, and XLK represents almost 9% of the fund or ETF's assets. And Google is $1,000 a share. So think about that. Let's put this into perspective for you. If you had $50,000, how many Google shares could you buy? Well, that would buy you 50 shares, not even a 100 share even lot. You can't even buy that with $50,000 with Google now $1,000 a share. So here's another way to play Google. XLK. XLK, which tracks technology stocks within the S&P 500. You get 73 stocks, of which Google is included, along with Apple and AT&T and IBM. So you get all these world-class technology companies, and you don't have to spend $1,000 a share to get exposure to these companies. That's because ticker symbol XLK trades at around $33 a share. So think about that. Those of you that want to play Google or some of these tech companies, some of those social media companies also are included in there. Well, not directly. You don't have too many companies directly in there. But for example, Google is very much involved in the social media movement. Yahoo is also involved to some extent in that. So think about that. XLK as another way to play the technology sector and to participate in any more upside growth that could be ahead for Google and this sector. 877-711-5611 is the number. We're here. My monthly ETF Profit Strategy newsletter for November has just been released. Some of the highlights: Reckoning Day delayed. Of course, that's been the mantra on Wall Street and the media. Disaster averted. Disaster averted. Well, that's true. Temporarily so. We're still going to have another political debate or political bickering, political turmoil upcoming over the next several months. And I think it'll be good. We've seen the VIX, although it's been one of the best performing areas, the best performing area leading up to the debt agreement, it has since collapsed. It's now back to 13. I mean, it was just under 20. So we're going to see another good setup for you volatility longs that want to go long the VIX again. I think we're going to get some nice opportunities to make some money there for those of you with non-core or what we shall say risk capital, the part of your portfolio that you can afford to trade with and risk. Also in the ETF Profit Strategy newsletter, performance chasers beware. The Dow is already suffering. Our junk bonds confirming the market's top. Also, my mega investment theme report, ETF performance trends. We've got the highest yielding ETFs listed, along with a breakdown of all the top performing sectors. And globally, one of the most popular features is my global equity map, which is also included. Just go to etfguide.com and use Trade Up. That's the promo code. You'll get a $50 discount. Now, I don't want to offend any accountants that are listening to the show, but the word accountant is actually derived from two root words, to count, and the other part of that, the word ant. So put another way, accountant literally translates as to count very little. Now, mathematically speaking, here's the equation. Accountant plus accounting equals little counting. So that's the mathematical equation. Now, at first glance, I know this provocative formula, it doesn't sound right. But after considering the U.S. Treasury's 5-month game of using extraordinary measures to avoid going above the debt ceiling, it makes perfect sense that accountant literally translates as to count very little. Now, the U.S. debt ceiling debate, this past one and the next one, because we're going to have another one in the future, is completely irrelevant because the U.S. Treasury Department has already blown through the ceiling by using accounting shenanigans that would put ordinary citizens behind bars. When will the credit market, when will the bond market wake up to this reality? Well, it hasn't yet, but someday maybe it will. We want to be ready for that trend, by the way. Now, we've got a table in the November issue of the ETF Profit Strategy newsletter that gives you a visual picture, and it's right straight from the U.S. Treasury's website, that shows what has happened just one day after the U.S. debt limit was suspended. In just one day, the U.S. government's total public debt was lifted by $376 million to now at just over $17 trillion. Think about that. $376 million in just one day. At that same borrowing velocity, we should have no trouble getting to $18 trillion by February of 2014. That should be a cinch. We'll be monitoring this for you. It's just one of those interesting points. I wouldn't say it's a leading indicator. This is definitely a tertiary or secondary indicator, but it's something I'm keeping an eye on. 877-711-5611 is the number. And again, if you ever miss our daily or weekly broadcast, you could pick up our free podcast. Just search for us at iTunes or YouTube. And precious metals, well, you know my opinion on precious metals. They have not been the ultimate safe haven trade. In fact, leading up to the debt ceiling agreement or debate, gold was one of the worst performing assets, falling 2%. So it's not a safe haven trade at all. And it continues to just be a trap for suckers. And we continue to see false breakouts in the price of gold. So I think we're going to see some more downside in gold. But again, we are your place that will keep you abreast of this, and we'll keep you on top of it. Well, that does it for another episode of the Index Investing Show. Thank you so much for joining us and being with us. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.